exam, 1-page exam. Then we're gonna start in on chapter 2. Hopefully we'll finish chapter 2. All right, so let's take a look here. I think we were on problem 8, maybe. Okay. No, we're not. We're on 10. I'm sorry. I think there's only 2 left here. I think 10 and 11. Yeah. Okay. Okay. Joan bought 25% of Ericsson Corporation. The book value of the stock was 260,000. The patent was okay. Well, let's do the easy entries first. All right. Now, what's gonna be the journal entry when we buy this stock?
Cash and investment equity should be the 2 accounts, right?
Yep. So investment. Equity. That is an asset going up for 300,000. In cash, yep. Cash is going down. You don't have to put this in, but asset going down thing. The only reason why I put the plus and the minus in is just to kind of show you where it goes back to like this. Assets increase with debits, decrease with credits. So, what's this? I don't even have it on here. I don't have investments on here. Well, investments is an asset, and it's that's bizarre. Investment handout not to have investments. Anyway, any asset increases with a debit and any asset decreases with a credit. So that's why I'm putting in that plus and minus thing here. Okay, so that's the first journal entry. Let's go to the income. And had net income of 100,000.
So it will be like 25,000, yeah?
Yep.
Investment and equity in invested income.
Good.
Mhm.
Okay, so we have 100,000. Oops. So their share will be 25,000. All right, so our investment in the equity is going to go up. Our investment just made money, kind of like money going into the piggy bank. Oops. So we own 25% of the company. We're going to get 25% of the income. I think I just told you guys put this just into investment income. I think that's what we were using before. There's nothing wrong. There is the account of equity and investment income. It's the same thing. I think I just told you guys put investment income just for simplicity.
Yeah, I would like to just ask you, Professor, when we will do the assignment or exam, what account title we should to just use? What we use right now at the class, or like we have in test books, or I know that we different had account title on the at the
Yeah, they'll usually give you,
intermediate class. So
no, the book shows it, you'll see this any number of different ways. I'll tell you one of the weird things about US accounting, and that is we don't have standardized account names. So you'll see some people call it one thing, some people call it another thing. I think the book uses the term equity investment in income. So, but you can, you'll see it different ways in different ones. Giving you kind of an international thing, the country that has the most, or used to, I don't know if they still do, it was Germany. Germany used to have, you can call account anything you want, but they used to have a numbering system. So any account that started with a, 1,000 would be a cash account. Account that started with a 2,000 would be accounts receivable, whatever. And you can call them whatever you want, because people just went by the numbers. But yeah, we don't actually have a standardized accounts. But yeah, I'll accept either one. I'll accept any of them.
thank you.
And usually if you take the CPA exam will give you, there'll be drop downs to see what accounts are entered. So whatever account is generally around the, says something along the lines of income in the investment or investment income or something along those lines. That'd be the one you pick. But yeah, it's we don't have a standardized account naming system. Kind of unfortunate, but anyway. And there are sometimes you look at accounts that you wonder what they are. I've seen accounts labeled customer deposits, which are really just cash accounts. They'll have customer deposits, then customer liability, and you get kind of the wacky accounts sometimes. Okay, let's do the dividends. So the dividends, the total paid dividends of 60,000. What accounts are we going to use? Yep. So
Cash and investment equity, 15,000.
Yep. I'm not gonna put that there. We'll put an envelope. Yeah, it'd be 15,000. Let me put the calcs in here. And our investment account is going to go down. It's sort of like we took money out of the piggy bank. We're really no better off than we were before. We have the $15,000 in cash, but now our piggy bank, our investment account is $15,000, is worth $15,000 less. So really are just trading one asset for another. The cash goes up, our investment goes down. Okay, the last one is the wacky one. They tell us that the book value of the stock purchased was 260,000. They don't tell us the total assets and the total liabilities, but whatever the difference is between those two, it was 260,000. The excess over the book value was due to a patent. Okay, so how much was the patent worth? Yep. So the patent, we paid 300,000. The book value is 260.
40,000.
40,000. Yep. Okay, now we have to figure out how much we are going to depreciate from this thing. Now, if you're wondering, do we have to take it 25%? It's already given, this 25% is already in the value of the stock purchased. So this is already the 25%. We don't need to do anything more with the percentage on this one.
Divided by 10 years.
Yeah, so it'd be 4,000, 40,000 divided by 10, what is it, 4,000? Oops. Okay, so we got the patent value. Now, so part of this, of the 300,000, 40,000 was that patent. Patents don't live forever. So we have to write off 4,000 of it. What is the journal entry going to be to reduce our income?
Investment income,
Investment income, yeah.
Mhm. We'll go down by 4,000. Oops. And yeah, investment equity.
Equity. Mhm.
And one thing to notice on this method, we don't really care what the stock price is or anything like that. We own so much of it that it doesn't matter what the stock price is. It's part of our operations. Sort of like if you're driving your car, it's something you're using, what the market value of the car is doesn't really matter while you're using it. And again, I think I meant, oh wait, I didn't put the pluses and minuses in here. Oh, from last class? I don't know if I have another one.
If not, I can. If not, I can access it online then.
Yeah, I can,
Are these the ones?
there's a practices in.
Anyways, I'll access it online.
Okay, all right. Yeah, I can,
No.
all right, so let's see, I know what I was gonna say. Notice in each one of these that the investment account shows up in every single journal entry. So if you're doing the journal entries for these and it doesn't have the investment account, you may want to take a look at it again, make sure that you're doing it right. I tell you what, let's see what would this thing be worth at year end? Let's see, we have investment of 300,000. Plus our share of the net income, which was 25,000. Minus our share of the dividends, which is just switching one asset for another. Why does it keep doing that? Oops. And then we're also going to subtract out, this is going to be the amortization of the patent. Oops. Minus 4,000. Oh, that one's bigger than the other ones. Let's make them all big. So this will be our ending balance in our investment equity, so at year end. So this is at, 1, and investment equity at year end would be. 306, thank you, yep. So that would be at year end. And we would keep doing this year after year until, for the next 10 years. All right, see if you can do number 11 on your own. I'll get you a handout. Yeah, so see if you can start on that one and I'll. Fill it in when you come back. Okay.
I think we are going to some. No.
India. Yeah. Wanna go?
Someone.
Hmm?
Someone.
December?
Someone.
Summer. Oh.
Policy, yeah. I'm just gonna this certain question. Okay. Oh, I know. I teach you guys how to be lazy like me. Let's see. Okay, so 70. $35% of the income, right? Okay. And they got cash of 35,000. In this method, you're indifferent to. It's just making more cash, but your investment's worth less. Okay, let's sort out this stuff. 30,000 was due to a copyright. And the excess was due to goodwill. Okay, so oops. Okay, so oh, that's not how you spell equity. Okay, so let's see, we have the book value was 370,000. So there's an excess of 50,000.
Hmm.
$370. Okay, so there's an excess of 50,000. And they tell us that that excess of a copyright for 30,000 and the rest of it was goodwill, right? We talk about goodwill?
No.
No? Goodwill is when there's a business, usually it's when a business is being run better than normally. In other words, it's producing more income than you expect from their assets. That it has that there's a value to that. Sometimes it's called the unidentifiable assets, which I think is kind of a bad term because it is identified, but but the unidentified as far as tangible, certainly. But this is an intangible here, but and this is an intangible asset too. You can't put your hand. The idea is this, like for instance, McDonald's. If you put a McDonald's sign out in front of your hamburger place, and you put Mark's hamburgers out, which ones that sign may cost the same, but the sign of the McDonald's sign is going to bring in a lot more people. It's worth more, even though it costs the same. So that's kind of what goodwill is. And you pay extra. So of this 50,000, 30 goes to the copyright, and the rest of it goes to goodwill. And goodwill is not written off. The copyright will be. You see how many years? Oh, yeah, here, 5. So the copyright is going to be written off over 5 years. Oops. Okay, so I'm just going to put it up here to put copyright. So our share of the copyright is 30,000. And we are not writing off the goodwill. If we were writing off the goodwill, we'd put in an entry for it, but at this point, we're not writing off a goodwill. Divided by, I just said it, 5 years? You guys almost said it, 5 years. Is it 6?
Yeah, it's 6,000.
All right, I knew that. So 6,000. And we're going to do this for the next 5 years. Write that off. And then at the end of the next 5 years, then we'll stop writing it off. And whatever, this extra investment that we made will run out. And if you think about it, that copyright is, if the life is only for 5 years, we will stop having the extra income from it when it's in the patent bill. Okay, let's go ahead and do the practicing. Hope I have enough. Right at the end. Okay. And the practice exam is just one problem. Practice.
Yes, I just got it.
Oh. Okay, so let me pull it up.
Professor Mark, I have a question. So
Yeah.
for the assignment, can we like print out the PDF, pages and all that, and can fill everything in and then scan and send it to you? Is that okay for you?
Absolutely, absolutely.
Perfect.
So we just finished up this handout, and if you did it in the file like I did, you can just send that file in. If you did it by hand, you can simply you can take pictures of it or scan it, whatever you want to do to send that in. If you did it on notebook paper, you can just take pictures of the notebook paper and send it in. That's fine also. So no, I can check it off in class. If you're in class, I can check it off in class. But if you're not in class, this is. It says bad request. Okay. Yeah, so let me show you what I'm doing here. That would probably be helpful. Okay, so in the, oops. So all assignments and exams, here's the chapter 1 handout equity. So you're gonna click right on the, if you're playing along at home, you're gonna click right on the 414 chapter 1 handout. Click on that. And it'll give you the options of create a submission. That's if you want to do it in Blackboard. Usually people do it, upload the files. So if you upload the files, now for all of these are unlimited. These have unlimited attempts. They're unlimited. You can put as many files as you want in there. So if you have 10 pictures from 10 pages, you can put all 10 pictures in. There's nothing wrong with doing that at all. If you put in the wrong file, let's say you put the wrong file and you go, oh, I got, you don't need to contact me to take it out. Just put it in another file. And when I check in the homework, I go to the last one first, assuming that that's the one that you wanted me to see. You don't need to contact me to, reset it or anything like that. You can just put it in another one and it's, that's fine. Up here, it talks about submitting, oops, don't do that. Up here, it talks about submitting work. The only thing that we can't do is and that makes it look worse. Zip files. If you're using Windows, zip files and Apple has page files. Do not submit those in Blackboard. Blackboard doesn't like them, and what it does is it shows the account pending, and I can't stop it. You can also resubmit it after that. That one will just be sitting there, but it for whatever reason it doesn't like zip files. It doesn't like page files, and I wish it did, but it doesn't. So zip files and page files are the only thing that you should avoid in the submitting. Anything else though, pictures, scans, the files themselves, anything you want to, however you want to load it up there. And you can load up 10 pictures. There's nothing wrong with that at all. And if you want to do it on notebook paper, you do it on notebook paper and just scan, take pictures of those or scan it, however you want to put those in. Let's see here. Yeah, so this one, if you want to submit it, it'll be here. If you're in the classroom, I can just check it in. Okay. Okay, let's go to the practice exam. This practice exam, while it's short, it is a little bit tricky. We gotta do all the calculations for it, basically. Okay. Joan Distribution bought 30% interest in Swan Song for $50,000. Joan was able to exert significant influence over Ericsson. Identified assets. The excess equipment will have a useful life of 10 years. The excess patent will have a useful life of 6 years. Okay. All right, so let's take a look and see what they bought. The calculator? Oh, I got a phone. Huh? 185? Okay, so the fair value of the assets is 185. The fair value of the liabilities, I think, is the same, 55. Okay, so the total book value of this thing would be what? $130,000? Okay. So what would be the book value of our investment?
Times 30%. Mhm.
Times 30. The book value of our investment is, well, whatever that is. Would you say it was 39,000? I better use the calculator. Yeah, it's late. Better use the calculator. Okay. Yeah. Okay, so this is the book value of our investment.
39,000.
Yep. Okay, so this is the book value of our investment. Now let's see up here, that we have this excess assets up here. Yep. And oops. Oh, I see. Just click on it to get rid of it, but it didn't work. Okay, so here's our excess. Now we don't get all of that, we get a share of those. Yep. So we get 30% of this. And we get 30% of this. Oops, too many. Okay. So this is our share of it. All right, yeah, we can do that. Let's do the depreciation right here, just because it's easier. It's right there. The excess equipment will have a life of 10 years, so we're gonna divide that by 10 years. So this is what we're going to take out of our income. Depreciate on it, basically. 600. And this one is by 6 years. So these are gonna be the what we're gonna expense on here. I think we got all the numbers we need to do the journal entries. Paid 50,000. We have the income to, okay, yeah, we got enough. Okay, so let's see, this is 1-1, I assume. Okay, yeah. So we bought this investment. It's an equity investment. I kind of don't like that title for it because, you know, you can have investments in equity that are not using the equity method, but our asset going up. And whatever we paid for it. We paid cash. Down. Okay, net income. we don't get all that net income. We get 30% of it.
$7,500, right?
Yeah, yeah. 7,500 you said? Yeah.
Yeah.
Okay, so that'll be our share of the net income. Okay, so what's the entry?
That's me.
Yep. And if you think about it, we own quite a bit of this company, so when this company makes money, we're happy about that, and we pick that up as our own share of it. And we say our company's worth $7,500 more now. And this will be investment and income. Could be in equity and investment income. And dividends. Another 8,000. And dividends, we kind of, we don't really count, don't count them as income. It's just exchanging assets. 2,400? You want to check. Oops. 2,400. Okay, so while we get the cash, we don't do cartwheels because we have the cash, because our cash went up, but our investment went down. Yeah, kind of like taking money out of a piggy bank. You take money out of a piggy bank, yeah, you get the cash out, but the piggy bank's not worth less. Okay, now we have these extra expenses that we're going to have. You could do these separately. I think I'm just going to add them up. You could definitely do these separately if you wanted to. Nothing wrong with that at all. What is that, 1,100? So I'm just gonna put them both in together. And again, if you want to put them in separately, absolutely you can do that. All right, so we have to reduce our income by 1,100. So we're basically gonna reverse this one from here. Here's our income. We have investment and investment income. We're gonna reduce our investment income. $1,100. And our investment account will go down by 1,100. Oops. Okay, now for the really tricky part. Our book value of our investment was 39,000. Right? Okay, so let's, I'm gonna do it right here, actually. Okay, so our investment in equity was 50,000. Our book value of the investment $39,000. Oops. So the total excess is
11,000.
1,000. Now, some of this we identified. Our share of the equipment was 6,000. By the way, this is a extra credit on the test. Oops. And excess patent. That's kind of funny. I'm gonna put this down. Okay, so we identified what, 9,000 of it? So how much is goodwill?
2,000.
Yeah, so goodwill is whatever's, some, in the book, they'll call this the unidentified asset. Yeah, it was a funny term, but, let's stick with it. The unidentified asset would be the goodwill of 2,000. So these two, we will write off, like we did up here, 600, 500. And this one, we will not. Goodwill, you generally don't write off unless there's a problem with it, unless it goes bad. So this is our breakout of the, of this excess, 11,000. 6,000 goes to equipment, 3,000 goes to patent, and 2,000 goes to goodwill. So on the test, I'll ask you what the goodwill is, and that's, extra credit. I made an error. I made a bad error. What is my bad error?
The total assets minus the liability.
Yeah, this up here, this is at fair value, not book value. The book value would be, let's try this again. That was the evil teacher talking to you just now. The book value of our investment is 100,000. Over here. I apologize, guys. It's the book value of the investment is 30,000. So the excess is yeah, 20,000. Okay, so what would our goodwill be? So this is the real excess, not what I had up there. Excess. Do I feel stupid right now? So what would our goodwill be? It won't be 2,000.
11,000?
11,000. I apologize, guys. There's nothing worse than learning it wrong, because all right. So I'm sorry, goodwill would be 11,000. The book value is 100,000. So the book value of the investment would be 30,000, the excess would be 20,000. We identified two of those, 6,000 and 3,000. The rest of it's goodwill. By the way, if you ever guys ever see me doing anything stupid, let me know. I apologize. I don't try to do things stupid, but there's that extra fun of seeing how many things I get wrong. All right, any questions on that? Afraid to ask. So this would be our goodwill. So the excess, the book value of the investment would be the 30,000. And by the way, feel free to take pictures of that, scan of it, or in the classroom, you can take a picture of it too. Okay. All right, so on the exam, that'll be it. So I'll send the exam out after class. Do you guys want to get the exam to print it out? It was either in class.
So I have a question, Professor.
Yeah,
So from the asset, you just subtract the excess of equipment and patent?
yeah.
Oh, okay.
Yeah, because these two are included in the total price we paid, the 50,000 includes those two excess assets we have. It includes a third one that the book would call unidentified, but it's we would call goodwill. And this is an asset. It's just this is what they would call unidentified. It's an intangible. Well, I like the patent, it's an intangible, but we generally don't write it off. Okay. Let's go ahead and, oh, here, let me put this up here. I'll take a screenshot of it, or, oops. Get it all on one page. All right. Let's go ahead and take a break. What is it, 7:02? We'll be back at 7:12, how about? And we will start in on the chapter 2 handout. And I'm gonna pass those out, make sure I have enough of those.
Do we also submit the practice exam too, or no? That one's
Oh,
us.
yes, the practice exam is also gets turned in. So you just click on there, turn it in, so we'll turn that one in also. Possibly get the chapter 2 handout. Let's see. Get the chapter 2 handout in then.
Okay.
Oh, no, I got it. Here. Here. Is that this one? Okay, let's go ahead and take a break. We'll take a break and be back at Say be back at. I think it's at 7:02. And for you guys in the classroom, I'll go ahead and write and run off the tests. And give you guys those, you can take them with you and you can bring them back next week.
Sorry, it's 7:04 right now.
Yeah, 7:04, yeah.
Oopsie daisy. Okay, I'm not really good at numbers, guys. May have picked the wrong field. Okay, be back at 7:12. Okay, I'll be right back. Let's go to.
Professor, I have a question.
Yeah,
On practice number 8, we just focus on a fair value when we calculated amortization, the question number 8. And right now with the practice exam, we were focused on book value. Why?
yeah, let me pull it up. Let me pull it up. I think on number 8 is the way they gave it, this one.
Yes, yes, this one.
On this one, we actually didn't, we could do this one the same way. I could show you what it would look. I mean, you're contrasting this one with the practice test, correct?
Yes, yes.
Yeah, so this one, oops. Here's what this one would look like, put it in the same way we did the practice test. The book value, the investment.
In a practice exam, we just focus on book value and we calculate the rest, and we did the investments and the rest. But here in this question, we just focus on a fair value of asset and liabilities.
Yeah, there's nothing, they're actually gonna be the same. Let's see here, let's see, we have. How much we pay here? 57,000. Our book value would be 320 minus 180. If we were gonna use the book value for this. Oops, wait a minute. What's 320 minus 180? 140?
Yes, 140.
Uh, 140, and we would get 30% of it.
$42, yeah.
So those would be the book value of our. I mean, yeah, it's a different way of putting it. I maybe should have. So our excess assets would have been 15,000. And it just so happened that that is exactly what we had for the equipment. So the identified asset would have been
I see the different right now. But
Yeah,
when
yeah.
I did the practice exam by myself and I was focused on a fair value, my goodwill was different amount. You know what I mean? When we
Yeah,
did the practice, yes, I have goodwill 2,000, but exactly 11,000 when I just count everything from the book value, not the fair value. So this one, the difference in my calculation. So
it should, well, the difference is that the fair value is what I think I showed you guys using the fair value. There's different ways of showing this. So this is what it would look like the way I did it on the practice exam. And there would be no goodwill. Everything would have been identified. I'll tell you something odd though about the goodwill when it comes to the journal entries here. And that is while you can identify it, it actually has no bearing on our journal entries. Because we don't depreciate it or amortize it. So it wouldn't matter on these even if we skipped it for the journal entries, but in this case, the goodwill would be 0. And let me do the fair value. We could have done the fair value and the fair value would have included those two. Because you'll notice that the fair value we had for this one in the beginning, that included the 15,000, it was 57,000. It included that, 15,000. So this is book value does not have that 15,000 for, it's kind of two different ways of doing it, but it's the same thing.
Okay, thank you.
I apologize, I didn't realize I was doing it a different way. I should have stuck to the same one. All right. Oh, where am I? Okay. Yeah, so so just the if you do if you do the net book value, it will include all the identifiable assets. So it'll include the assets at book value. If you do the fair value, it'll include the identifiable assets at fair value. It will not include the unidentified asset, which is goodwill. I know that's kind of quirky sounding, but that's kind of the way it is, yeah.
Professor,
Yeah,
I'm still a little confused. On this practice exam that we just, problem that we just did, if the total assets book value would normally on a balance sheet include the unidentified assets, right? That aren't listed here in the problem.
no,
But
not a book value, they won't.
The total of the 155 equals the numbers above it, so it's not, the unidentified is not included in that total assets.
It won't be included in the book value. I tell you what, I do want to make sure that this is done the way that we. I'm going to do this again and do it exactly like it is on that other one. So if we took the book value, the net assets at fair value, it would have been what I had in the first place, the 130. And we would take the so that would be including the identifiable assets, would have been 130. Would have been 39,000, and that would have included that would have included these two. The 6,000 and the 3,000 would be included in those identifiable assets. The unidentified asset, the goodwill, would not be in there. I wonder who came up with this, so, notice that 85,000, that includes these excess assets. Now, these are identifiable assets. These are not the unidentified assets. So identifiable assets were 39,000. So, yeah, so that would be what we done. So our investment would look like this. 50,000. the identifiable assets, which I didn't do on that other problem, by the way. I didn't. The unidentified, this would be goodwill. Would be the other 11,000. Now that three, but yeah, it is confusing, because that 39,000 includes the 3,000 and the 6,000. So those would be in the identified assets. And again, the book, the book probably, I think it shows it this way, I believe. The unidentified asset, they call goodwill, which is kind of a funny name for an asset, unidentified, because you actually do know the name of it. But what they mean is that it's not identified as either a tangible or intangible asset. Up there anyways. This is actually an intangible asset, but yeah, so it's kind of a funny terminology. I don't know what else to call it, but so the identified assets would be 39,000 and the goodwill. And if you look up at this one up here, the way I did it was I did it at book value, and then said, okay, the difference at book value would be, these are the identified. And this last one would be the unidentified. I do apologize for doing it two different ways there. It's while they come up with the same answer, it's confusing to see it two different ways, and I generally try to avoid that. I think I did that because that was where our last one was shown. Sometimes you have to do them to, I would adapt them to book problems. So that's kind of why I would, if I show it two different ways, it's because the book will show it two different ways. But anyway, so this is, you know, so the identified asset would be the book value of 30,000 plus those two. And those would be unidentified. Whereas this one, those two are included in that identified assets.
Thank you so much. Right now I see the difference.
Yeah, it's the same thing. And I believe that I was matching this up. A lot of these problems that I have in these handouts come out of the book. They're basically come out of the book, and they're book problems that I try to put in a similar format. And sometimes it's just trivial, the differences, and sometimes it can make them confusing. And I'll tell you, the ones that are the most confusing are the ones that are where they do too much of the work for you, because you don't know where they got the number from. They just show it, you think, where did that number come from? And you know, if you were to actually just to do it, they would make sense. Okay. We'll get started on this one, chapter 2. We're probably not going to finish this one. That's fine. I do have a test for you guys. All right. So this chapter assumes that 100% of the subsidiary is purchased. So no more of this 30%, 25%, 40% stuff. This is 100%. We buy the entire subsidiary, 100%. We bought all of it. Okay, now, when we buy the entire company, there are two different things we can do. We can dissolve the company, say, okay, you no longer exist. We're going to pick up your assets and liabilities. We bought the company, you get all the assets, you get all the liabilities that go with it. And we are going to eliminate that company. It'll no longer exist. So your assets will become our assets and your name will disappear. Another way to do it is the company is not dissolved. And if it's not dissolved, you run it as a separate entity. So it's a separate entity that is being run as a separate entity, different than the company, than the company that bought it. And this is the one that is more complex, because this is the one where you take the financial statements and jam them together. So the first one is the company is simply dissolved. The second one is what happens if you operate them separately. You might operate them separately for a number of reasons. It could be that they're doing very well, and you know, you want to leave them alone, and you may sell it off as a separate entity in the future. You want to keep them separate. It could be, I remember seeing in one article that IBM bought out some small firm that was doing some innovative stuff or, you know, different things. And they had them completely separate. And it's because they, you know, IBM is a pretty stuffy company. IBM is, they have layers and layers of management, which is generally not what you want for people developing software and stuff like that. You want a little more free to think freely and all that kind of stuff. So they decided that they were going to keep them separate just because they didn't want, they wanted their free spirit to be to continue. Okay. Amount paid is what you gave them, and fair value received is what you got for it. We can talk about these as we go on. Amount paid equals fair value received, no special accounting rules. If the amount paid exceeds the fair value, you'll have goodwill. The amount paid is less than, you'll have a gain on bargain purchase, which we'll talk about later. Direct costs, we're not gonna do too much with this stuff. Direct costs are expensed. Yeah, indirect costs are expensed, and the securities and issuance registration costs are actually, they reduce the amount of paid in capital. So it's basically, if you sold the stock and they took off some of the fees, well, whatever the price they gave you for the stock minus the fees that they withheld, you know, it would be a reduction of additional paid in capital. Okay. Eliminating entries, we won't get to this today, but let's go to this one down here. Okay, so they gave $150,000 cash. That's page 3, number 3. By the way, one of the confusing things about my handouts, so I try to make them not confusing, and maybe it makes them more confusing, is a lot of times I'll try to get the page numbers and the problem numbers the same. Just in case someone's looking at page 3, it'll be problem 3 the same. Okay, so this is what they bought. And let's see what they get. So they paid 150,000, the fair value. Amount paid, cash 150,000. Oops. And the fair value of the assets received, and the fair value is, we're done looking at the identifiable assets. So we paid 150,000 and we got 150,000 worth of net assets at fair value. So how much goodwill will we have?
0.
0. Good. So none. Okay. So this is, we're going to dissolve this company. So we're going to pick up their assets and we're going to put, the current assets we'll put on as the same, just as current asset account. Could be cash, it could be inventory, whatever. Let's pick it up just to ease of doing the journal entry. We'll pick up the current assets. Will the assets, when we put them on the books, will they be debits or credits? Debits, good. Okay, so we'll have current assets. I'm gonna try to get these a little closer together. Still kind of far apart, aren't we? Okay, current assets, land, buildings. Land, buildings, equipment. And we're gonna put these out to fair value. 45, 15, 140. And 70. Oops, no, that's right. We have these liabilities. Debits or credits on those? I don't think we, good, yep, they are credits. So accounts payable, loan payable. So we just picked up all their assets and all their liabilities. What else do we need? Good. Cash is going down. $150,000. Okay, if you make a lot of mistakes like me, it's not a bad idea to add up both sides. I just add those up, they're already added up here. 270, okay, so 270 is on the debit side. So hopefully we should get the same on this side. Yep, and we do. All right, so if those two sides equal, it's pretty good indicator. You don't have to do that, but whenever I do like problems with and lots of numbers in the debits and credits, it's good to take a look at them, make sure that they balance. Okay, now the next three though are pretty much the same. And if you want to, you can just, for these ones up at the top here, you can just say, you know, put in the same or whatever if you want, because these are going to stay the same for the next journal entries, next problems. Okay, so this is if they paid 150,000 in cash. Let's go to the second one. Everything's exactly the same. Again, if you're doing this by hand, just say same as above for that stuff. Now, everything's the same, except they paid 174,000 in cash. So let's take a look up here. They paid 174,000. They got 150,000 for our fair value of assets received. Those are the identifiable assets. So how much is goodwill? Yep. So goodwill will be 24,000. I'm going to copy the arrow here. Okay, so here's how this is going to change down here. We're going to put goodwill on the books. I'm going to insert it here. You don't, you can just put it, actually, I'll just put it down here. Doesn't matter. The books tell you that debits go first and credits go second. That's not always the case. I guess I could. I'll put it up here. Okay, so goodwill will be on the books for 24,000. How much will we take out of cash? Yep. And that goodwill will just sit there like a lump. Yeah, let's make sure that these add up. 270 plus 24, 294. Okay, so this one is a little bit different because it's got the goodwill on it. So, and again, the book would call this an unidentified asset, but it's actually an intangible. So goodwill is done when, you know, they have they're earning a higher income than they normally should for the amount of assets they have. Okay, let's go to the last one. And again, these would all be the same. And by the way, on the tests and that, you do not have to put them in order. You don't have to put debits first and credits second. There is no accounting rule that says you have to do that. Okay, this one. Everything's the same except they bought it for 132. So they bought it for 132,000. They got 150,000 worth of assets. So what are we gonna do with that one? Yep. Good. Now here, this is a fairly new rule, by the way. Generally speaking, you cannot simply, you can't, uh, you can't recognize a gain on a purchase. That was for when I was when I was growing up. Now that was a rule for everything. On a purchase, you could not recognize a gain. You can only recognize a gain when you actually sold something, not when you purchase it. This is an exception. You recognize the gain right when you make the purchase of it. And the reason being is that the way we used to do it in the past is we would reduce all of the values of the assets. Now, notice that that means that the financial statements are going to be misstated. Right? I mean, if the current assets are 45,000, if we reduce it by some amount, it's misstated. You know, same thing with buildings, equipment, all that kind of stuff. So because of that, they said, okay, this is like one of the exceptions. We will recognize a gain. We allow you to recognize a gain on this. Okay, so we come down here. Our cash we paid out is 132. Oops, nope. Okay. And now this is a one-time deal. We'll have gain on bargain purchase. Oops. And this is one of the very few situations where you can actually recognize a gain on a purchase. For the most part, it's a no-no. You know, so you buy inventory at a good deal, say, oh, I have a gain on it, not until you sell it. When you sell it for more money, then you recognize the gain. But this is a little bit different in that this is going to be on the books for a long time. And the feeling was that if we reduce these accounts, we're misstating those asset accounts. And by the way, that's what a company's judged by. How are they using these assets? You know, so if you misstate those assets accounts, it really kind of messes up with the evaluation of the company. They'll generally look more profitable than they really are because they have more assets that they're working with than is shown in the books. I'm gonna stop there. Yeah, let's stop here. This one's gonna be a little more work. Okay, so leave this up for a second. So those of you playing along at home, I'm going to send out an email with your I'm going to send out an email with your with the exams on it. Those of you in the classroom, I will hand you the exams. I think I'll send it to you in your email too, though. All right, let's see here. Okay, so I'll wrap this up here on the Zoom meeting. So we didn't finish that. So this will be emailed to you guys after class. Any questions? And I apologize for showing you two different ways of doing the same problem.
And today's recording will be at the Blackboard, right?
It'll
This
be,
class.
by the way, yeah, I say within 24 hours. I usually try to get up the same night. There's rendering that goes on, but it'll usually I can get it up at the same night. So hopefully by midnight it'll be up.
Thank you.
It might be up before then. I tell you what, I can I'll send out an email when it is up. Okay, any questions?
No,
And
we're good.
so check your email. I'll be sending out your exams shortly. Okay,
Thank you, Professor.
thanks, guys.
Thanks, Professor Taylor. See you next week.
Professor, good night.
Good night.
Good night. Thank you.